Well, good morning, good afternoon, good evening for those of you watching in England. Welcome to the Capital Markets Wrap, sponsored by Polly. And, it's been a while, Dawn and Ira and James, since we've kind of gone around the horn and introduced ourselves to the folks who are tuning in. And we do thank you for tuning in to this show. Like I said, sponsored by Polly. So why don't you guys tell the audience about yourselves in, a paragraph or less, starting with Dawn, starting alphabetically by first name.
All right. Well, thanks everybody for joining. I'm Dawn Meshel. I currently am EVP of Operations Enterprise Execution at Plaza. Been at Plaza for 16 years. Been in the mortgage industry for considerably longer than that. But currently at Plaza, I oversee all of operations, wholesale, national correspondent, operations and underwriting, IT, strategic initiatives, vendor management. So kind of a wide variety of things there. And in the mortgage industry in general, I have pretty much done most jobs. I was in sales at one point. I've been an underwriter at my DE and my SAR, started at an IMB, worked at a bank at SunTrust for a while in the late 90s, early 2000s before I came to Plaza.
Wow, what a pedigree. Ira?
Ira Selwin, Vice President of Capital Markets at U.S. Mortgage Corporation. I've been here at the company for 18 years, so quite a long time, over half of my mortgage career. I started off, we have something in common, Rob. I started my career at Crossland Mortgage back in the day. So I know we have that in common. And, after a few years, moved to a few different places and have sort of found my home here at U.S. Mortgage Corporation. We're an independent mortgage banker. We have, 49 states that we're licensed in, doing business all around the country, Fannie and Freddie, seller servicers. And thank you for having me on the call.
Well, thank you. James?
Yeah, absolutely. So good afternoon, everyone. James Baublitz. I'm the Senior Vice President of Capital Markets for First Home Mortgage Corporation. We're based out of Baltimore. I'm still the newbie here at First Home. I've been here for about 4 years. Prior to that, I was at Compass Analytics for about 10 years, where I left. I was the Managing Director of Pipeline Analytics when I left for First Home. But I've lived in Baltimore for quite some time, so it was a nice, easy geographic move. And I also one of the instructors for Panoramic Capital Academy, mortgage industry's hedging and risk management and all things capital markets service too. So I do that in some of my spare time as well.
So how's the academy doing? I know you guys are in the middle of the winter semester. Are things going well?
Yeah, absolutely. So we have a 14-week master class that we teach. That's kind of been our flagship. And then additionally, we just introduced late last year, an 8-week executive course too. So covering everything from introductory best execution to rate sheet derivation to hedging best practices and servicing valuation and the whole works, a little bit of attribution too. So no, it's been really good. Candidly, we just have been so thrilled with the feedback that we've gotten. So we're very humbled by that as well.
Good. We are, which reminds me, right off the bat, Dawn and I, we're going to go off script. Not that we had a script, but script is pure.
Ira, are we surprised by this? I'd like every time when Rob says that, I want to say that. Like, are we surprised? There is no script, just for all of our listeners.
I think everybody who's on this call, tuning in, and everybody on the screen here, you start off the day thinking that you're going to do ABC, and you end up doing XYZ, and you'll think, oh, I'll just do ABC tomorrow. I am asked regularly what book or books would I recommend for somebody just starting off in secondary marketing or wanting to learn more about capital markets? And you three are probably asked the same question. Lately, to James's point, I've been recommending the Academy to everybody who writes to me. But I wanted to ask Don and Ira, what would you tell somebody who, let's say it was a new loan officer at your company or a new account executive, and they said, "Hey, how can I learn more about capital markets?" What would you tell them? We'll start with Don.
Well, I would say I'd refer them to the Academy, because I don't know that there's a book I would refer them to. Like, from my seat, the most commonly referred book that I have referred in the last 6 months to people to read is more about kind of culture and team building, I'll be totally honest. So I've referred The 5 Dysfunctions of a Team to multiple people. But as far as capital markets, I don't have a book that I would refer. Sorry.
That's good to know, because Ira has a reputation in the industry for being not a team player.
So I should refer them to
he's like a lone wolf. That's what his nickname is, the lone
I'll
wolf.
send it to Ira.
So
For your
Ira, what do you tell folks?
Yeah, I mean, so I did join the Academy, so I can vouch for the benefits there. But there was a book I had to remind myself, Demystifying Mandatory, sort of an older book. I still have it in my cabinet here somewhere that I should probably pick up and just read again, because it's been a long time. But to Dawn's point, honestly, it's one of those things that there aren't a ton of sort of capital markets focused books or even courses, which is one of the reasons I actually joined the program myself. So I'm waiting for the. Are you going to be writing one, Rob, or are you going to be?
Yeah.
We'll get to me in a minute, Ira.
Oh, okay. Sorry. But yes, Demystifying Mandatory was the last one I read. And there is also a few others that I'll take that back as a homework assignment for next week, so I'll have a better answer for you.
All right. James, besides the Academy, what do you tell folks?
Well, I would say, kind of to the collective point, there's minimal coursework that is specific to mortgage capital markets in particular, because it's just kind of a niche. So I do recommend general fixed income principle books. Essentially, anything by Fabozzi is fantastic, but that's more markets and fixed income pricing and so on. I will go off script myself and recommend a book that is not the question that you asked at all, but one of my favorites, which is a book called Reminiscences of a Stock Operator. It's about this trader in the 1900s. And if you're a capital markets nerd like me, you like stuff like that. But it's all kinds of good market wisdom and the like. So Reminiscences of a Stock Operator won't help you hedge a pipeline, but will help you to invest.
Let me try to find that book. I've never heard of it. Usually what I tell folks is, demystifying mandatory. And I bring up this topic in general because somebody from the MBA wrote to me, and they were after looking at demystifying mandatory, and they went online, and it was $95 at Amazon. And so they knew that I knew Jen Fortier, who wrote the book, and asked me if maybe I could help them get a deal with Jen, which I did. So if you ever want to read that book, I can get a lower price than you'll find it on mandatory. But you're right, there's not a lot of stuff out there. In the 1980s, a fellow named Jess Lederman wrote a book which was a collection of essays from people in secondary marketing / capital markets, which I have. But to tell you the truth, I would just read back then in the US mail, companies like Goldman Sachs or Morgan Stanley would send out periodicals on the MBS market or secondary marketing. And I still have many of those. But you're right, there's really no book per se, just like there's really no book on how to be a loan officer or how to be an underwriter, other than very industry specific resources. And a lot of it is just learning by doing. It is really interesting how we, the collective, we have created this industry without some kind of user's manual per se, for everything. So it's pretty interesting. It is interesting. So Dawn, you have and of course, watching this show, I think people pick up a lot, and I've received some very good comments, and you can also learn from companies like Poly, because typically Poly and other vendors will have some very experienced people in them, and so they're good at instructing how. Harley. So I'm seeing a note here from Deb about Harley Bassman. I went to school with Harley Bassman, Deb. I have some stories that I will be glad to share with you from when he and I were 18 and 19 years old at UC San Diego. But anyway, that aside, Dawn, you've got quite this pedigree. Have you found that your background in underwriting and IT, I mean, all these things that's thrown in, help you do your job in terms of knowing what's going on in the capital markets and giving you a unique perspective? And if so, how?
Yes, I left out one piece of what I've done. When I started in the mortgage business, I actually worked at a lock desk for an IMB, and then I started managing the lock desk. And it's kind of funny what you just said about understanding the mortgage business, because actually the person who hired me just said, "Do you know math? Do you know how to read fractions and decimals?" And I was like, "Yeah, why not? And I know Excel, sure." So I think, starting with that foundation, it kind of just built over time. So I think having that general understanding of I didn't even know what a lock was. At the very beginning, you think about it, someone was like, "Lock my loan." And I'm like, "Lock it where?" So I think over time, it just, it helps to understand, that you have to understand where the actual, margin is, what you're making on a loan, because all of that profitability plays into how to manage operations and underwriting and just the overall business in general.
Yeah. Ira, did you ever study the Black-Scholes model?
I did not. I'm surprised you don't have it on your background today.
Well, that's because I'm, in this studio. James, have you?
Sure, options theory and the whole works. Yeah, absolutely.
Yeah, it's interesting because I studied it in the MBA program at Cal, and then when it came time to do the job of secondary marketing and so forth, my boss asked me if I knew it, and I said, "Well, I don't know it by heart." And he said, "Well, you don't need to know it by heart, but that's the theory that we use when it comes time to price an interest rate lock." Because basically what you are doing is you are giving a borrower something for free, something that has value. A mortgage company is giving them an option for free, and that option is to put the loan back to the company, to fund the loan with the company, or if interest rates move lower, you're not going to get that loan, in theory. Now, what happens is, Ira, I'm just spouting off here to some extent. What happens is you have this theory, the Black-Scholes model, and it's been modified and so forth, but it's a way of pricing that option, that put. But what happens is behavioral economics factor into it, and you can't really. It's hard to model. The moving van is showing up in 2 weeks. Do I want to move my lock? Or, I really need to pay off this high interest rate credit card debt. I'm just going to stick with this lock period. So human nature enters into this theoretical formula, which is what makes this business interesting. So, all right, enough. I'll take off my professor hat. I'll let James's Academy, go off on that. But Ira, I wanted to hear what's been occupying your email time or your phone call question time recently within the markets. We haven't had a lot of tweets necessarily that have come from the administration, i.e., President Trump recently that I know of. But what's on your radar screen in terms of current events?
I think the most recent comments has really been, focused around the Federal Reserve, and maybe possible changes ahead with a new Fed chair announced that's coming out in May, or any Fed movement whatsoever. So, it's been interesting. The data has sort of been up and down. We've sort of been in this, limbo, floating around in this sort of limbo mode, or however you want to phrase it. But rates haven't really done much, right? So it's really just enforcing, behavior in regards to locks. Even if something doesn't happen, it's more about giving feedback and telling our salespeople, listen, we know rates have been steady for the last 2 months. However, these are the items that could possibly impact rates. And it's basically preparing salespeople and preparing the loan officers for where a retail sales is coming out, the jobs report is coming out, inflation data is coming out, that even if it doesn't move rates, at least you're prepared to keep your borrowers informed at these different data points that could possibly move rates. And then the second piece, as I mentioned earlier, is the Fed. The possible impact of a change in the chairman come May. Obviously, there hasn't been much of a reaction, right? Everyone sort of knew what's coming. The Fed isn't the only one that makes the decision. Last Fed meeting, we had 2 people that dissented. So, just sort of reinforcing those ideas and trying to get people away from the social media headlines or the clickbait, those type of things, and say, listen, don't pay so much attention. Social media has sort of run amok, right? Anyone could tweet anything, as you mentioned. But it's sort of taking a step back and realizing, okay, take a breath, realize what people are doing. Some people are just tweeting for the sake of tweeting. So it's just sort of take a step back and realize the true impact of what's happening, which is not too much in the market right now.
Yeah, that's a good answer. James, are you seeing the same thing with loan officers? Do you ask differently? Do you think that they are have become more and more accepting of the current environment, like rates are where they are, and let's just forge ahead and grind away day in and day out? Or do you think there's still a school of thought out there among originators saying, oh, I sure hope we get rates in the 5s or maybe the 4s?
Yeah, I mean, certainly, I would say both as a starting point. I do agree with your phrasing of acceptance. I was making the joke for a very long time that we were going through the stages of grief as an industry, and I do think that we've gotten through to acceptance at this point. That broadly speaking, I think to overgeneralize, I think 2026 is probably going to look a lot like 2025. Maybe not exactly the same, but give or take. Yes, we might see rates move down into perhaps the 5s, but personally, I'm a little skeptical of the 4s and so on. And I think the further away we get from the 2s, probably the better. So yes, I think there's hope for sure. But I think there's also a lot of acceptance. And I think that certainly is the conversation that our originators are having with borrowers, is that, we don't have a silver bullet coming in terms of a path back to a 3.25 note rate, for example. The other thing that I would kind of add as a topic from the LO community is all things involving refinance strategy and the like. I thought PennyMac's earnings call was instructive last week, and for anyone that didn't see, they had a tough quarter. But one of the themes that they articulated was how much competition there was in the market these days. And big picture, when rates decline, historically speaking, generally speaking, lenders maybe have not quite enough capacity, and so there's opportunities to widen profit margins just a little bit as they increase lock volume. And the comment that they made was, look, they saw the refi opportunity coming. All right, here comes the playbook, here comes the capacity, here comes maybe some profit, and it went the other way. And they just kind of singled this out and said, hey, it was an interesting time in the market. And I bring this up, of course, not to pick on PennyMac. They're an extremely well-run company, and they'll be just fine. I bring it up to say, some of the best in the industry are saying, hey, this time is a little different. The refi game, the state of technology is a little bit different, and so on. So bringing it back to a retail IMB, I think the thing that's interesting to me about that is it's very instructive to a retail loan officer. They have very, very fond memories, of course, of the refi boom in 21 and 22 and the like, right? But is it different this time? And are we going to see kind of a different approach to all things recapture, all things refinance, and so on? So I think it's a really interesting topic. I thought it was very interesting to come from someone who, again, does very, very well in terms of recapture. I have a lot of respect for PennyMac. But it's interesting then to take those lessons and perhaps apply it to a retail loan officer perspective.
Yeah, I should say so. And of course, there are those out there who say, well, even broker shops are filled with, in effect, retail loan officers, dealing with borrowers and so on. And I wanted to come back to, excuse me, Dawn, because Plaza obviously has a name for itself out there in the wholesale community and dealing with brokers and so forth. Any trends that you are seeing in terms of broker shops and their view of the markets?
Well, I totally agree with everything that Ira and James are saying. I would say that we see locks happening later in the process because of, I think borrowers are a little more informed, but I think it's, they're all waiting for rates to go down. So it seems like, when we would see longer locks and see them earlier in the process, now it's definitely, like we could have a loan that's getting like almost clear to close and they're locking at that point, because I think at that point, the borrowers accepted that, the rate is going to be where it is. It's not, going to be 3.5 miraculously. Which
is not going to happen. But so sticking with you, Dawn, I've seen graphs, and the number of mortgages outstanding 4% or lower is gradually declining.
Yeah.
As people sell their homes and or refinance to get cash to pay off debt and so forth, without revealing too much about Plaza's model and so forth. Are you seeing that at Plaza?
Oh, definitely, for sure. I think we were probably 75% purchase or more a year ago. And now I think I was just looking at our most recent pipeline and we're almost like 40% refi, which is not typical for us. But to me, that definitely means that people are either accepting that rates aren't going to go down. And it helps because of the originations over the last 5 years, right? Rates have just continually gone up. So we are seeing higher rates. So I think it's a little easier for, borrowers and loan officers, right, to do a refi at current rates. So we definitely are seeing a shift there for sure.
Yeah. And just to add on to that, I think there's one thing that Dawn just said that I think is so spot on when you're talking about borrowers' awareness. I'm of the opinion that basically right now we're seeing the most savvy and informed borrower ever, that they're more in touch with where rates are. They haven't forgotten where rates were, right? And yes, to your point, they're begrudgingly accepting that they're locking at, pick your favorite number, 6.5%, 6.25%, whatever, right? But they're very aware and they're very savvy and they're very aware that rates have been lower in the past. And so while they are proceeding and living their life and hopefully making that purchase transaction or perhaps refinancing and so on, I think that just speaks to some of the psychology and the behavioral facts that Rob was mentioning earlier, is that I think the borrower in 2025, 2026 and beyond is just a different state than they were a few years ago. So again, I think that all goes to origination and refinance strategy generally.
So there's a comment in the chat from Audrey. She says the industry is blocked out that they excuse me, that they whined and complained all the way through the last refi boom. They were so tired. And then the next 3 years with frozen business. So stop wasting stop waiting for booms, which I agree with 100%. I know Audrey, and she's a trooper in terms of just a disciplined approach to lending. She also said, we wait to lock because we were trying to stay ahead of the previous swooping in and taking the loan. True. The psychology of waiting for interest rates, I think, I would say the experienced people who are out there in terms of originators, I've never, and I've used this line before on this show, I've never heard an originator, whether it's an LO or a broker or whoever, tell a borrower, hey, you know what, rates are going to come down. I know rates are going to come down in 3 months. Come back in 3 months and I'll refinance you then. You know, nobody ever says that. Nobody. What originators tend to do is give the borrower a competitive rate. And as I understand it, some borrowers, they're aware of rates, but they realize that maybe their loan is a little more difficult to do. So they don't care as much about interest rates as they may have in the past. And so they are happy to have a loan, happy to have the program, and happy to have the loan officer helping them. So just my 2 cents.
Just one more thing to add on to Audrey's comment, especially some of the bigger servicers out there, they have a lot of data and they're using, predictive models. They're using AI. I know I had to say that, the AI for today. But, with the amount of data that they have, they're being very proactive in predicting when those borrowers will need a refinance. So it's more than just, the old, let's wait to pull credit so they don't get a payoff. And, that always helps. But a lot of servicers are now using predictive technology to anticipate borrowers refinancing to really get ahead of themselves.
Yeah. Dawn, I don't remember the lengthy list of disciplines that you've been in. Servicing, Plaza has a servicing portfolio, correct?
But I don't have anything to do with servicing. That's all Mike Fontaine. We'll have him as a guest next time.
All right. Nah, I don't want Mike on here. No, I'm just kidding. James, in terms of servicing, there is the thought out there, gee, Rocket, Redfin, Mr. Cooper, etc. I'm just doing, I'm part of an IMB. We're doing, 30 million a month or 100 million a month. We don't have a lot of servicing. Do you see these monolithic organizations who have servicing just dominating the industry from here on out? Or do you see them as potentially dinosaurs that get too big for their own good and then fall into the tar pit, allowing the nimble, smaller groups to come in and do well in this business?
Well, I think what I would say is that the industry is big enough for all of us, perhaps to use an optimistic tone today. I think that certainly there are some borrowers who love kind of the simplicity of everything and the automation that goes with everything, and candidly are a little bit more transactional than others and don't necessarily value the relationship, and that's fine. There's plenty of entities for them. The flip side, of course, maybe to give a little hope to those who aren't working for the monoliths, is that as much as we talk about the efficiency that comes with AI, as much as we talk about the predictive analytics and so on, that's not always the thing that people want. Sometimes people want that relationship. Sometimes people want to be a little bit under the radar and not necessarily embrace the fact that all their information has been sold and has been used to predict all this stuff. It's funny. It was about a year ago. I was teaching a class in person, and I was talking about recapture. It was a secondary class, as you would imagine. And I was talking about recapture, and all of a sudden, one of the students who worked in the mortgage industry jumped out of her chair. And she's like, is that why I'm getting all these emails from whoever it was? And she went on this 45-second rant about how frustrated she was and how she was never going to do business with them again, et cetera, et cetera, et cetera. And my long-winded point in all of this is That's an example then of someone who has the experience, has the data, is part of the ecosystem, if you will, and is freely choosing to opt out. They're almost certainly not going to use that lender for the next loan and so on. So I think there's both. I think broadly speaking, there's more competition than ever. And I guess the good news for consumers is that they, generally speaking, have a little bit more ability to choose which adventure they want to go, right? So yeah, but I do think it's. I guess I would wrap that up by saying, for lenders out there, I just think that this topic is about as important as it gets. And I think it's just really important for a lender to look themselves in the mirror and be able to articulate their recapture strategy. Are they going for it and they feel like their technology is best in breed too, or are they not, or are they somewhere in between? And so I think it's really, really important because I don't think the old model is working quite as much as it used to.
Yeah. To that point, we actually, I posed the question to sales and my sales management. I said, how do you feel about the fact that we sell loans to, and this was, I'm not going to mention the name of the investor, is this an issue? And the response was, no, we don't see it as an issue. So it's sort of supporting your point, James, that, people know the names, they're going to get the solicitations, but, we don't have an issue with you still selling those loans to them.
So do you think I'm going to ask a question. I'm going to go off track here, but I just was curious. Do you think that a borrower has any impact on that? Do you know what I mean? So if a borrower had an issue with a particular servicer, that then do they, because that's what I think sometimes I hear more even than just, the loan officer or the broker, but it's more like, this borrower doesn't want their loan to go to this, right?
Yep. We see that all the time. Just as we sell loans, we see that all the time, that either A, loan officer indicating, hey, we really need to retain this one because that was part of our, kind of value prop. Or B, whatever you do, the borrower said, do not sell my loan to XYZ. And again, I think this just goes back to the state of the borrower at this point, is that I feel like I'm seeing that more. And I feel like that just, again, speaks to the savviness of a borrower. Sometimes it's really great to have everything on autopilot, and some people don't mind getting, an email a day, if you will, saying, hey, rates are really low. That's a convenience, right? Just click a button and maybe refi. But some people get beside themselves frustrated with it. Again, no one's right or wrong. I just think that I think it's different, is I guess the point that I would make.
So I'm going to tell a quick story. In the meantime, Dawn, I want you to think about AI, because I'm going to ask you about AI, since Ira keeps bringing it up incessantly. So we should probably talk about it. So my mom, I'm talking about a half a century ago, okay? Half a century ago, 50 years ago, and my mom and dad in the house with rotary dial telephone with the stretchy cord, and you had to be at the phone to talk on the phone. And every year my mom would wait for the local real estate agent to send out the magnetic calendar that she could put on the side of the refrigerator next to where the phone was, so that she could, if she was on the phone talking to somebody, she could look at the side of the refrigerator and there was this magnetic calendar. It was a big deal for her. And that was marketing. Back then, that was marketing to have that. Fast forward to now, obviously, you have a plethora of more touch points with consumers, chances to market and so forth. And I tell originators, actually years ago, I started telling them, borrowers need more than an email twice a year reminding you, hey, change your clocks, this upcoming weekend. That just doesn't cut it anymore. Borrowers are a lot more sophisticated. There's more knowledge that originators have about them, and there's more that borrowers expect. One of those things, of course, is technology, and you can't go to a conference now without some session about artificial intelligence, and you can't turn on a financial news show without hearing about the stock market gains from companies who are in AI. Dawn, you touch many parts of the company. Can you provide folks on the call with some kind of advice or some kind of thoughts that you've seen at Plaza with regard to AI? Are there things that it can't do? Are there things that you've been able to accomplish with AI that have helped the company? And how would you even approach thinking about AI if you were a small or mid-sized lender?
Ooh, that's a loaded question, but I would say there's a couple areas where we actually have implemented it, and there's some that we're still working on. So one area that, I think lots of people started with, right, is our resource center, just kind of, our guidelines. And so we implemented some AI, just, chat functionality there. Challenges with it because it doesn't always give you the right answer, right? Because sometimes it's looking at tables in a guideline and it doesn't come back with exactly what you're looking for. But I would say that we have to and adopt it because everyone is at some point. I also have seen where we've adopted some AI with income calculation. It's good, but there's still work to be done there. So, an asset verification as well. If I was a smaller company, what would I try first? I would probably try the income. I would just start with income because it's a good starting point, and there's a lot of I would say conflict between operations, underwriting, and sales on how income's calculated, just because it's so important now in the loan transaction. So it's kind of, I don't know.
Ira, is U.S. Mortgage doing any quote AI? Oh, Ira's like, like
No,
what?
I'm just sort of agreeing. No, I as Dawn mentioned, income calc, the guideline piece, I think, is probably the lowest hanging fruit. I feel like it's the easiest to implement.
Right.
I'd say so many people have used the chat GPTs of the world. They're used to entering that data and having that ability. So we've rolled out an internal guideline tool where someone could just type in a question and they can get their answer. So I think that's the easiest to sort of roll out and implement. But there's other things that we're developing internally. We're using some of our vendors to chatting with our point of sale system for the uploading of borrower documents. Right sizing the documents if they upload it upside down, and putting it into the right category and encompass, things like that, sort of focusing on sort of streamlining the internal process and just trying to get that loan to closing quicker and trying to request less documentation and less information from the borrower and sort of having that work done for them a little bit.
All right. James, I'm not going to ask you about AI.
Mixing it up on me.
I should say, I'm not going to ask you about AI implementation. I'm going to throw you a curveball. As I understand it, and if you don't feel comfortable talking about it, feel free to have me, refer the question to Dawn. But I've heard that mortgage fraud, continues to ratchet up, and AI is a part of that. That artificial intelligence has increased or led to an increase in the amount of fraud that lenders are seeing. Can you answer that? And like I said, if you're not comfortable answering it, I'm going to turn it over to Dawn. But James, are you hearing or seeing that same thing?
I hearing the same thing, hearing the trepidation, hearing the fears and the worry, and candidly, as you go through all the documents that are required and all the processes of a mortgage, especially if you know a thing or two about origination, you could look at that and say, well, gee, I can see 10 different ways that you could use such a thing for that. But knock on whatever wood is convenient. We've been fortunate that we haven't been running into that here as much. And I guess perhaps on a positive note, there is also the opportunity of being able to use and leverage it to try to catch fraud. I was attending a conference a couple months back, and actually it was one of the JP Morgan Chase conferences, and that was something that Jamie Dimon articulated, is that That's been one of the biggest things that JP Morgan Chase has been successful in, is implementing AI to really scale up some of their fraud detection services and so on. So that's kind of been my experience, but certainly I defer to my colleague here, Dawn. What are your thoughts?
I would agree with you that fraud's definitely increased for sure. I don't know that AI has contributed to the actual fraud, like misrep, but AI has helped us to find it more. So I would say it's pretty much agree with what you're saying exactly. I mean, it's unfortunate that that's where the industry, we're going back to that. 'Cause sometimes I do feel like we're going backwards in that area for sure. Unfortunately.
Yeah. Not a good situation if you're if you're an investor, some money manager in South Africa who's buying $500 million of mortgage-backed securities. You may not be able to do due diligence on every loan, or maybe through automation or AI you can, but a portion of the fraud is something that occurs in mortgages that you don't know about for months, if not years, after you buy the loans. And so it can be obviously a real problem there. Jack, thank you for the note, Jack. Jack is asking, are there any vendors you would recommend for product guideline resources or matrices? Ira, since you mentioned it, what would you recommend?
So we implemented Guideline Guru, and it's it's simple format. We partnered with them for a variety of different guidelines, Fannie, Freddie, investor guidelines, things of that nature. So that's one, and there's a couple others in that sort of world. I just don't know the other names offhand, but if you did a good search, or maybe we can follow up after, we could probably get those for you. Maybe it'll be in the future Rob Chrisman newsletter.
There you go. John, James, any suggestions?
We did a kind of a custom proprietary one, but I'll be checking out Guideline Guru, Ira. So thank you.
Yeah, the other big one would be probably All Regs, but yeah, to your point, we've recently introduced an in-house kind of chatbot as well. That's leveraging that too. So that I know we've mentioned it, but that has been one of the more practical from an AI point of view, is simply the idea that yes, is it going to be 100% accurate? Probably not. Is the guideline individual 100% accurate all the time? Probably not. So it's a good thing as well to really scale and give certainly our guidelines team a little bit of a lift too, in terms of all the questions that they get.
Yeah, is
I'm
Guideline
sorry, go ahead.
like a competitor to All Regs?
Yeah, it's similar sort of format, but I was just going to mention one more thing. You were talking about the AI and the fraud, and we talk about borrower fraud, but we didn't even get into bigger picture, where voice masking and things of that nature, where you can have owners of companies sort of impersonated and instructing employees to do things, closing issues. So there's a host of some scary things to sort of take a look at, and we always have to be careful what we wish for with some of this AI technology.
Yeah. In fact, I should tell the folks on the call here, and once again, thank you very much to Polly for sponsoring this. But the last call that I got from Ira, he was in a Philippine jail, and he needed bail money, and I fell for it. So Ira, I'm glad.
But thank you, because that was not AI. So I really appreciate it.
Good. Thank you again to Polly, and thank you for everybody for tuning in for 45 minutes or so to the show here. I think this is a very popular show. I have a good time doing it, and I think it's very informative. And Don, Ira, and James, thank you for joining and chipping in and being good sports and all that, and listening to my stories about my mother and the magnetic calendar on the side of the refrigerator and the phone with the catch. So anyway, Until next month, and good luck in the conference circuit over the next 2 or 3 weeks. There's a lot coming at us. So take care, everybody.
Thanks, all.